Hi, my name's Phil from Peter Johnson. Now we're going to look at how to calculate and report your Australian income. If you have income from Australia, such as pension, salary, self-employment, dividends from investments, bank interest and capital gains, then these gross amounts must be reported on your French tax declaration. Australian pensions can be taxed in France and not taxed in France, but all pension income must be declared with the gross amount. That's before tax has been deducted. You need to select if your Australian pension has been taxed on the way in or on the way out. Then we can determine if it should be taxed in France or not. However, according to the Articles 10, 11, 12 and 13 of the France-Australia Double Taxation Treaty, Australian dividends, interest, some royalties and capital gains will be taxed in France, subject to a credit of any tax already paid in Australia, so you will not be taxed twice. For income tax, you can be taxed up to 17.7% on dividends and 11.2% on interest. Therefore, if you have paid 15% in Australia, you will be charged 2.7% in France. These incomes will also be subject to prélèvements sociaux, otherwise known as social charges. The rate is 17.2%. So, if you have €1,000 worth of Australian dividends, you may have paid €150 in income tax in Australia. In France, you may be asked to pay another 2.7% income tax. That's €27. And another 17.2% in social charges. That's €170, equaling a total of €197, which will be payable to the French tax office on an Australian dividend of about €1,000. We have recently checked the application of the Double Taxation Treaty and have been sent written confirmation that these taxes apply. To calculate the gross income and tax already paid in Australia, you will need to refer to your statements. These statements should indicate an income code, the currency, the gross income, and the non-resident tax you've already paid. I hope that helps how to submit your Australian income.